What happens when a central bank intervenes not by selling dollars, but by directly restricting how much risk banks can take in currency markets? And can that kind of intervention actually stabilize a falling currency? India's rupee recently fell to a record low of 94.81 against the US dollar, before rebounding to around 93.60 after a regulatory move that caps bank forex exposure at $100 million. This video examines what that decision changes, why it was made at this specific moment, and whether it can hold under mounting external pressure. If the policy succeeds, it could temporarily stabilize the rupee and reduce speculative pressure in foreign exchange markets. If it fails, it exposes deeper structural vulnerabilities tied to oil dependency and capital flows. If extended or intensified, it may reshape how Indian banks operate in global currency markets, potentially reducing liquidity and altering hedging dynamics. At stake is not just short-term exchange rate stability, but confidence in how emerging markets manage volatility during global crises. To understand the significance of this move, it is necessary to examine the institutional role of the Reserve Bank of India and the historical evolution of India's currency management. The RBI has traditionally relied on a mix of direct intervention, such as selling dollars from reserves, and regulatory tools to manage volatility. The rupee operates under a managed float system, meaning it is influenced by market forces but subject to periodic intervention. Over time, India has built substantial foreign exchange reserves to buffer external shocks. But those reserves are not infinite, and persistent pressure can force policy adjustments. The current episode is rooted in a convergence of external and internal factors. The war involving the United States, Israel, and Iran has disrupted energy markets, pushing up crude oil prices and tightening global supply. India imports approximately 90% of its oil requirements, making it highly sensitive to price increases. Higher oil prices translate directly into a wider current account deficit, increasing demand for dollars and placing downward pressure on the rupee. At the same time, foreign institutional investors have been selling Indian assets, contributing to capital outflows that further weaken the currency. The key policy shift came when the RBI, under Governor Shaktikanta Das, moved from a relative cap on bank forex exposure, previously set at 25% of capital, to an absolute limit of $100 million in net open rupee positions. This change directly targets the scale at which banks can engage in currency trading strategies. It represents a tightening of market conditions, aimed at reducing speculative activity and limiting the buildup of positions that can amplify volatility. One of the primary targets of this policy is the arbitrage trade between onshore and offshore currency markets. In recent months, offshore non-deliverable forward markets began pricing in a faster depreciation of the rupee compared to onshore markets. Banks exploited this gap by buying dollars in the domestic market and selling them offshore, capturing the spread. These positions reportedly grew to between $25 billion and $35 billion, creating additional demand for dollars in the domestic market and contributing to the rupee's decline. By imposing a strict cap, the RBI effectively forces banks to unwind these positions. This reduces immediate pressure on the spot exchange rate, but introduces new risks. As banks exit trades, they face losses because the spread between onshore and offshore rates has widened significantly. The one-month non-deliverable forward points surged to around 100 pace, compared to the 3 to 5 pace levels at which many positions were initially established. For an estimated $30 billion arbitrage book, each one paisa increase beyond the original spread translates into approximately 300 million rupees in losses, or about $3.2 million. This creates a direct impact on bank profitability. Treasury operations, which often rely on such arbitrage strategies, are now exposed to potentially significant losses. Bankers have reportedly sought a 3-month extension to comply with the new limits, arguing that an immediate adjustment could cause market dislocation. The RBI, however, set an April 10th deadline, signaling urgency in addressing the issue. Recent market behavior reflects both the immediate impact and the underlying uncertainty. The rupee's rebound from 94.81 to around 93.60 suggests that the policy had a short-term stabilizing effect. However, analysts such as Dhiraj Neem of ANZ have indicated that while near-term stability is possible, the fundamental pressures remain unchanged. The currency's trajectory will continue to depend on external factors, particularly energy prices and capital flows. One possible scenario is that the policy achieves its intended effect of reducing speculative pressure and stabilizing the rupee within a narrower range. In this case, the RBI could maintain the cap as a temporary measure while relying on improved external conditions, such as lower oil prices or renewed capital inflows, to support the currency. This would represent a controlled intervention that buys time without fundamentally altering market structure. A second scenario is that external pressures intensify. If oil prices continue to rise or capital outflows accelerate, the rupee could resume its downward trend despite the restrictions. In this situation, the RBI may need to combine regulatory measures with more aggressive dollar sales or additional policy tools. The effectiveness of the current cap would then be called into question, highlighting the limits of administrative controls in the face of global market forces. A third possibility involves unintended consequences within the banking system. If losses from unwinding arbitrage positions become significant, banks may reduce their participation in currency markets, leading to lower liquidity. This could increase volatility rather than reduce it, particularly if market depth declines. The balance between stabilizing the currency and maintaining functional markets becomes more difficult to manage. The broader implications extend beyond India. Emerging markets often face similar challenges during periods of global stress, particularly when they are heavily dependent on commodity imports. The RBI's approach reflects a willingness to use regulatory tools alongside traditional interventions, a strategy that may be observed by other central banks facing comparable pressures. At the same time, it underscores the interconnected nature of global financial systems, where developments in energy markets and geopolitical conflicts can rapidly transmit to currency markets. In the end, this is not just a story about a single policy decision. It is a reflection of how economies navigate external shocks while trying to preserve internal stability. The outcome will depend on how effectively policy tools align with market realities, and whether temporary measures can bridge the gap between immediate pressures and longer-term adjustments.